15 years experience in the mortgage industry. We pride ourselves on our customer service, so we're always here to help you as clients if you need anything. And hopefully your schedule's not too busy. After the course is over, we're going to treat you lunch. So please stick around. The food here is great. We really have some others. So thanks for coming. Thank you.
Well, thanks. Like she said, my name is Chris Busch. I've been in the credit repair business for over 10 years. This is Erica. She is our Houston rep. So she's here today, kind of help coordinate this. But we're happy to have you guys. And so the class is a 2-hour class. If you fill out the sign-in sheet, put your truck number on there. Usually after a couple days, I'll get it put into the system, but then you should see the credit and everything in your account. So let's get started. Thanks, Erica. And I'll be, there's some stuff here that's kind of like mortgage related, so I'll be hitting up Abe and Ray for some questions and stuff like that. So you guys get ready, get your mortgage hats on.
Always on.
I know. All right, so you got a handout here. We'll kind of follow this. If you look, there's a little section on the back to take notes, but people write all over it. But this is a good kind of reference to reference back to as you go. Any questions that you guys have, I don't mind answering any questions, just raise your hand. Now if there's anything specific like, you know, hey, I've got a client right now and I brought their credit report and can you take a look at it and tell me what you think, and this happens, so that's why I bring it up. So just let's hold those kind of questions to the end. We'll take them offline, maybe schedule an appointment or something like that to discuss them. But if there's anything general that's specific to the topics that we're talking about, well, I'll certainly answer the questions. Don't be offended if I say, hey, you're leading up to what we're about to talk to. I might do that as well. So, all right. So what's in a credit score? Now, when you look at a mortgage credit report, now how many people have actually looked at a mortgage credit report before? Wake up close. So why do you see 3 different credit scores on a credit report? You guys are at least familiar with that there's 3 scores, right? Does everybody know the names of the 3 credit bureaus? Correct, yeah. So Experian, TransUnion, Equifax. Yep. But why are there 3 different scores? Information. That's actually part of it. So each bureau or each bureau will kind of have its own set of information that it's reporting. And basically what that means is a creditor may not report to all 3 credit bureaus. So let's just say a medical collection, for example, might only report to TransUnion, but might not report to all 3. Okay, so that would kind of help. That would bring down the TransUnion score. And sometimes you'll see this, and I'm sure you guys have seen this. Like, let's say it's an authorized user, and we'll talk about some of these other terms as we go in. But let's say it's an authorized user on a credit card, and it's only reporting to Equifax and TransUnion, but not Experian. Well, why is that? We'll talk about that. But those are some of the nuances of things that can happen on a credit report that can kind of mean that there's 3 different scores. But there's another big reason why you see 3 different scores on a credit report, okay? And the key term here is algorithms, all right? It's a fancy word for mathematical formulas, all right? So there's a lot of people that are probably a lot smarter than us that, get paid. I don't know how much they get paid, but probably more money than we make, I don't know. But, and then they think of, they come up with these formulas to show whether a person is credit worthy or not. So credit scoring basically began back in the 60s, where they came up with mathematical formulas to give to a bank and say, with this number, you can tell right away whether someone's going to pay you back or not. Now, it took a long time for that to really get adopted into the mortgage industry. It was in the 80s that it got adopted into the mortgage industry. So like back when my parents bought their first home back in 1978 up in Spring, they didn't have a mortgage credit score back then. It was literally the bank having to go through piles of paperwork to say, is this person going to pay us back or are they not? But then they said, well, it's much easier if there's just a number that kind of helps us. Now, that's kind of where the algorithm comes from, but each credit bureau is going to use a separate algorithm on a mortgage credit report, and each one is going to be different. Now, are there only 3 algorithms? You think there's only 3? No. There's actually over 100 different algorithms that are used to compute a credit score. Okay. Now, has anybody heard the term FICO? Yeah. Okay. Does anybody have like an app on their phone, like with their credit card, that tells, where you can click a button that says "See my FICO score"? You ever click on that? Okay. Does anybody know what FICO stands for?
I remember Fair Isaac.
There you go. Corporation. Fair Isaac Corporation. Okay. Yeah. So Fair Isaac Corporation. Now they're the ones back in the '60s that invented credit score. Okay. And so they're pretty much the law of the land for 90% of all lending decisions, not just mortgage decisions, but all lending decisions are using some sort of FICO-based algorithm. Now, I mentioned there's like over 100 different algorithms. Well, there's 49 different FICO algorithms. Okay. Now, in the mortgage industry, there's 9 different FICO algorithms. So you'll sometimes hear it referred, and I will refer to here, as the mortgage FICO scoring model. It's because it's specific to these 9 algorithms that are used. Now, are all 9 used on each credit report? No. When Ray and Abe pull a credit report, 3 of them are going to show up. Okay, it's going to be, most commonly, it's going to be Beacon 5.0, Classic 04, and Fair Isaac version 2. Does that mean anything to you? Not really. It means something to them. Okay. And there was a time in the mortgage industry where you would see different algorithms that were being used, and sometimes you would go to one mortgage company and they'd use a set of algorithms, and then you come over here to NRL and they might use a different set. Now, they're all pretty much the same. You're going to see that same algorithm being applied to each bureau the same way. So that's what that means is you go to NRL, you go to someplace else. If they're pulled on the same day, theoretically it should be the exact same score. There shouldn't be any differences, is really what that means. Okay. Now the 4 industries and where your score is calculated: home, auto, insurance, credit card, and the internet. We're going to dive in and really spend most of our time on the mortgage FICO scoring algorithm here, because that's obviously what we care about. The auto industry, just to point this out real quick, has anyone ever worked in the car business before? So sometimes you might hear something called a beacon score if you go into the auto world of auto financing. It's still a FICO score, but Beacon, because I mentioned, remember I said Beacon 5.0, so Beacon is a company that makes algorithms, and they just make them for the car industry. Okay? But typically a Beacon score or home or auto score is going to be higher than a mortgage score, and it's because it's the range is 50 points higher than that of a mortgage score. So usually if somebody goes and buys a car and they're 700, they go and have their mortgage credit report pulled, it's going to be around the 650 range. So, and a lot of people get confused, and I'm sure you guys hear this too, like, well, what are you saying? My credit score is this. I just went and bought a car last week and it said my credit score is higher. Well, that's the reason why. It's because it's a different algorithm that's being applied, so they're going to see a different score. Now, where you really see this, especially for people that check their phones all the time for their credit score, is the internet scores. Okay. Now, the internet has been kind of the wild west of credit scoring, and just like the wild west, things kind of tamed down and started planting crops, and things started kind of getting settled down. And same thing in the internet. It's kind of come down to where before there were 50 or 60 different algorithms that were being used out on the internet. Now it's pretty much one that's used the most, and it's a one called Vantage, and that's Vantage with a V. Okay. Has anyone ever heard the term Vantage before? It's one of those things that if you actually watch a Credit Karma commercial or Credit Sesame or there's other ones, the fast-talking lawyer at their end will say something about Vantage 3.0. Okay. And it's not a FICO score, it's a Vantage score. Now, where did Vantage come from? So I mentioned FICO is the one that started everything. Where did Vantage come from? Why did they use it? Well, Vantage was started by the 3 credit bureaus, Experian, TransUnion, Equifax, to actually compete against FICO. They said, well, let's come up with a better way to do mortgage credit scoring. And so that they came up with Vantage, and they were actually going to try to put FICO out of business. Well, that didn't really work very well for FICO. They fought back, and FICO kind of won that battle. But the three credit bureaus like, well, what are we going to do with Vantage? Well, they started selling it on the internet really cheap. And it's kind of morphed into Vantage 3.0. And sometimes when you hear things, and especially articles that I read about, oh, this is coming up in the credit world, or medical collections aren't going to count against your credit score anymore, or they're going to start taking into account your rental history and things like that in your credit scoring, it's usually Vantage they're talking about. And it's because the reporters are so dumb, they just don't know any different, and they report it, but they don't realize that that Vantage is not going to be used for a lending decision. The auto industry is usually about 50 points higher than a mortgage score, and a Vantage score is usually about 50 points higher than a mortgage score. So when you guys pull and somebody comes in and says, oh, my Credit Karma says I'm a 660, it's usually like, what, a 610, somewhere around there?
Yeah, I actually had one that was a 620 on their program, but then ours was a 550.
550, okay, yeah, 70 points.
Usually it is like 50.
Yeah, 50 points is usually the norm. I actually saw one the other day where the Vantage score was higher than the the mortgage score was higher than the Vantage score. That doesn't happen very often, but now the thing with Vantage and FICO, Vantage 3.0, they both go from a 300 to an 850. But what Vantage does is they take other things into account, they look at different things, and so the scoring itself just tends to be higher. Okay? And I always tell people, like it or not, the mortgage FICO credit score is going to be the lowest of all the credit scores you see out there. Even the FICO scoring models, if you go to myfico.com and look at all the different scores across all the different industries that are FICO related, the mortgage score is always the lowest. So, and people are like, but it's just the way it is. But it's the biggest purchase you're ever going to make. Is a home. So, any questions about where a credit score comes from? Okay, so let's kind of talk about the mortgage FICO scoring model itself. There's 5 different sections of the mortgage FICO scoring model. So 5, basically if you take a pie and slice it up 5 ways, that's what you get. We're going to kind of delve in and talk about each section of the mortgage FICO scoring model. The first section here is your payment history. It's 35% of your credit score. Now this is where all of your, anytime you make a payment on your credit card, your mortgage loan, your student loan, your boat loan, whatever, all of that information gets compiled into this section. Now when Abe and Ray pull a credit report, they see different information than you might see on a consumer report like through Credit Karma or something. And one of the things that they're going to see on there is a little number that says months reviewed. So that's basically the number of times that a payment has been made on an account, and that's what calculates here into this section, like how many times you've made a payment. So that's why, like a mortgage loan, it's going to score differently than a revolving loan, and we'll talk about revolving loans in a second. But installment loans, the more times you pay on it, then the more points you're going to earn, okay, in this section. So like a mortgage loan, like if you're 75% into that mortgage loan, it's going to be earning you big points because you've made so many payments on it, okay? But also what scores in this section is your negative information. So your charge-offs, your late payments, tax liens, judgments, collections, all of that negative information gets compiled here in this 35% section. And we'll talk about the negative stuff as well, kind of when we get done with the mortgage FICO model here. Now the next section here, amounts owed, is 30% of your score, and this is what's called your revolving credit. Now when I say revolving, do you guys know what I'm talking about? What am I talking about? Credit card. Exactly. So a revolving account is a credit card. It's different than an installment. Let me explain revolving versus installment real quick. So an installment loan is like, since we're here on this beautiful lake, Let's talk about a boat loan, okay? So you get a boat loan, it's 15 years. They're going to take that number of payments divided by what it owes, and then it's going to come up with a monthly payment of, let's say you have the huge boat and it's $700 a month, okay? So you're making that $700 monthly payment in installments. Now, if you get 50% paid off and you pay that boat loan off 50%, you can't go back to the bank and say, oh, hey, I want to buy some speakers for the boat and I'm going to borrow $1,000 against it. No, you can't do that, right? You'd have to either refinance the boat, or just like your car, you refinance it, or you can get a HELOC and things like that against your home. But that's different. It's not the same loan or the same what's called trade line, okay?
So does a home equity line of credit fall under this area?
But it's basically a HELOC is a revolving. It's not an installment, but you're borrowing against the asset, but not the trade line itself. From a credit perspective, it's a little bit different. So what happens with a HELOC is you'll see your mortgage loan here, and then you'd see your HELOC on a separate line item, okay? And it's a completely separate trade line. Versus a revolving loan, okay? When you borrow against it, you're borrowing against that trade line, okay? That particular item. So you have a Capital One credit card that's got a $5,000 credit limit. You go buy, a set of speakers and some, boat cushions or whatever. They cost $2,000 for your boat, and then you pay it off, and then you can borrow more money against it. Okay, it's a revolving door of credit. You buy something, you pay it off, you use it again. Right? You buy a set of tires, you pay it off, you use it again, and it's all on that same line item. Nothing changes on that line item. That's why it's revolving. Okay, so revolving specifically is in this section right here under amounts owed. All right. So now the first thing to point out about this, and we'll get into more detail about it, is if you don't have a revolving account or a credit card, you do not score in this section. You do not earn any points here. So you don't have a credit card, you're only scoring in 70% of the model. And I'm sure you guys see this over the years, that those people that don't have credit cards have lower credit scores than those people that have credit cards, right? And your first thing is like, hey, go get a credit card. And that's usually the advice that that we do as well. And we'll talk about that as far as building credit and things like that, and why it's so important. So just kind of file that away, but we'll talk about what happens when you do have credit cards in this section. So when you do have credit cards, it's going to score here in this section, and it's based off of the percentage of utilization of that particular card. Okay. So let's just say you have a Capital One credit card. It's got a $1,000 credit limit on it. You buy a set of tires for $900. What's your utilization percentage? 90%. Okay. You're utilizing 90% of it. Now at 90%, you also lose 90% of the points you could potentially be earning towards your credit score in this section. So you're probably all familiar with the term being maxed out on your credit cards, and you probably also know that it's not a good thing, So, and that's because the higher you get up on that scale, the higher that percentage of utilization is, then the less points you're going to earn towards your credit score. Now, if you pay that card down, let's say you get that card paid down to $300, you're now utilizing 30% of that line of credit. Well, at 30%, you actually only lose 10% of the points you could potentially be earning towards your credit score. So just by getting it paid down to 30%, you can get a pretty good chunk, score back to you. Now, is it still, some people will say like, oh, well, 30% is all you need to pay it down to? Not necessarily. Because at 30%, you're still losing some points. There's still some room to grow there. But a lot of times, if you get it paid down to 30%, within a few points, you're pretty much there. So that's why 30% is a lot of times used as that nice round number to get it down to. Now, a lot of times with Abe and Ray, they will have on their credit report something that will tell them exactly what you need to pay it down to and how many points you'll get. You guys use that quite a bit? Yeah, probably every day. So, but yeah, and it's a neat tool to be able to tell you, hey, you pay this card down to this, you're going to earn this many points, and we can get you qualified. So, and that's a part of what we do as well. If people need a little bit more help than just paying down a credit card. We do a lot more stuff for them, but that's one of the part. And we call it credit coaching, where we'll actually coach the client through what balances they need to pay down. But sometimes it's more like, hey Chris, I got $1,000 this month. Where can I apply it on my credit card debt to help maximize my scores and or maximize them over? And sometimes it's not just about paying down credit cards, there's other things too. We'll talk about that in more detail. Any questions about credit card utilization or anything? So the next section here is length of credit history. It's 15% of your credit score. Now this is going to be an average of all your open and active accounts, both your installment and revolving. Now in order to maximize this section, you would need 25 years of average credit history, so quite some time. Now, but the biggest thing to note here is that this is an average. So a lot of things play into that when you're talking about an average, like, if you add a new account, those kind of things can affect your average. Increasing your length of average. Well, how would you do that rather than just time? There are ways to do that. Let's talk about that first. So there are ways to actually increase your length of credit history. Let's just say husband and wife buying a house together, and I'll use a real life example. Wife had credit cards that had been opened up since the 80s, and husband had none. So, and he had no credit history. So then he got added on as an authorized user to her credit cards, and all of a sudden, boom, he had like 25 years of average credit history, and his score went up 90 points. Now, does it always work that well? No, but in some cases it can. But sometimes there is a case where maybe husband has a couple credit cards that are newer, wife has credit cards that are older. Well, let's get him added on to one of her oldest cards and help increase his credit history. So sometimes people will say, well, I'll just add them to any card. Well, no, that's not going to necessarily help. So if you have a Citi card that you opened up last year, that's not as helpful as that, Kohl's card that you've had opened up for 15 years, or that Macy card you have open for 15 years. That's the one you want to get them added onto, because it's going to increase the length of credit history in this section here. Okay. Now, there's some other things you can do to kind of hurt that average credit history, and that is opening up new accounts. So if you have one credit card and that's your only trade line, and it's 10 years old, and you add a new credit card, well, now what's your average credit history? 5 years, okay? Because 10 divided by 1 is 10, and now you take 10 divided by 2, it's 5. So now you've just cut, just by opening up that card, because you wanted to save 20% on your purchase at Kohl's or whatever, you've now just cut your credit history in half because of that, and you can see your scores drop as a result. Now, there's a whole lot of other reasons when you're trying to buy a home why you don't want to open up accounts, but from a credit standpoint, that could be a big killer for people that are trying to, do things that they think. We're just having this conversation in the car about a client that recently enrolled. Like, hey, I heard that getting installment loans can help me. I'm like, well, it can in some cases, but just doing it thinking that loan is going to raise your credit score may not be helpful, because it could hurt your credit history, among other things. Okay, so there's there's a lot of different moving parts when you think about what can be done. And so another example of that is banks and also credit unions used to market something called a credit builder loan. Have you ever heard of those? Have you guys ever heard of credit builder loans?
Might be called a different name.
Yeah.
I don't know.
Yeah, it's like a secured loan where you take like $1,000, you open up a CD, and then you borrow back against it. I was actually giving this presentation, similar presentation to the mortgage division of a credit union, and the president of the credit union happened to be sitting in, and he freaked out. He's like, when I talked about this, because I was talking about credit builder loans and how, because they were marketing it at the time that no matter what, in any situation, just by doing this loan, you will increase your credit score. And that was 100% false. I mean, it was completely false advertising. Chase got sued for a lot of money for this very same thing, because they were going around marketing that any secured loan that you do will increase your credit scores, and that was 100% false. And it's because of this section right here, it was a big reason for that, because if you you've got, you know, let's say you're a 715 and you're like, oh, well, I know that if I get a 740, I'm going to be able to get a better rate on my home, so I'm going to go to my bank and do this credit builder loan they keep telling me about every time I walk in there and, you know, and make a withdrawal, and that's going to help raise my credit score. And then they come and find out that their scores dropped 30 or 40 points. They're like, whoa, what's going on? Because they had great credit history. By opening up that one new loan, their credit history dropped. And that's because of this section here. And that's why you don't see them marketed that way.
I have a question.
Yeah.
So you're thinking about if you have one card, you're up there, you get another one that is divided, cuts it in half.
Mm-hmm.
How long does it take for it to recover and get back up?
Well, I mean, it's all about the law of its averages, right? So, I mean, it could take some time to kind of build that back up. I mean, technically speaking, if you were at 10 years of average credit history and you add one and it's 5, it would take 5 years to get back to that average credit history, right? So, I mean, I don't know, maybe not even 5. I don't know. I'm not a mathematician, so I can't think right, you know, from a math standpoint. But it could take some time to get back up to that 10 years of credit history. Now, these things are going to happen, but I also, when I talk about credit history, I also talk about depth of credit. So having just more than one credit card or more than one loan that's old, it can help you. So if you've got 4 credit cards and they've all been opened up for 15 years, and now you add one more credit card, well, that's not going to be a huge hit against you, okay? Or if you've got 3 credit cards open up for 15 years and you've had your mortgage loan for 20 years and then you go open up a new credit card, that's not going to hurt you much at all, you know? But it's for those people that, I see this sometimes where they've got like one account. But here's another thing that I see too, and it's sad when this happens, is I'll see people close old credit cards.
Early on in the 80s.
Yeah. And I was just looking at one recently where a client's scores were in the mid 400s, and there was a credit card on there that was opened up like in 1986, and it was closed down like just about a year ago. And I was like, that right there is the difference of you guys being a 473 versus like probably a low 600. Even with the negative stuff you have on there, with that credit history, you would probably be like a low 6s, and you might qualify for a program. Because they might be able to say, oh, well, your scores are good enough, we can take this and count it towards your DTI and work some magic or whatever. But at a 473, there's not much magic that can be done, right? Because they don't have a lot of credit history, and they ruin that by closing down their card. Another story is that I was giving this presentation to a mortgage company out in Marble Falls, and I remember the mortgage loan officer, the branch manager, stopped me. She's like, Chris, I got to make a phone call. She's like, I was like, oh, okay, what do you got to do? She's like, I just talked to somebody this morning that was doing Dave Ramsey and paying off all his credit cards and closing them all down. And he had written the checks, written the letters telling them to close down their credit cards. He was going to the mailbox. Luckily, he was out in nowhere, and it took him a while to get to the mailbox, mailing all these. She called him while he was on the way and stopped him from mailing these. She's like, hold on, I'm just sitting in this credit class, and I'm learning that if you do that, you will not get this refinance that you're trying to do next month, you know, on your property out in Marble Falls, because it's going to crash your credit scores because you're closing down all of these credit cards you've had open for a long time. And it's because you're getting rid of that length of credit history. So
when a mortgage comes to the end, you pay it off after 15 or 30 years, does that hit your credit also?
yeah, you can. Yeah. You lose that credit history.
That doesn't make sense.
It doesn't make a lot of sense. And that's why I tell people having a credit card can be your oldest trade line. You know, the best credit score I've ever seen was an 837, and it was a gentleman that had an American Express card opened up in like 1962, a Shell gas card opened up in 1965, and then a mortgage loan that was 75% paid off. Right? He had an 837 credit score.
Wow, we sold our house a year ago in Oklahoma, so that's all paid off in the spot. So we hurt ourselves by not still having that mortgage.
So you probably went from an 820 to like an 801 or something. That's not killing yourself. But I'm just kidding. But some people freak out about that, and I'm just making it kind of a joke. But some people do freak out about like, oh my God, I don't have an 805 anymore. Now I'm a 790. Is there a difference in rate between 805 and the 790? Yeah, there's not. As long as you're above a 740, you're good. credit scores are going to ebb and flow, so don't freak out too much about certain things like that. And I actually had an hour-long conversation with somebody who was threatening to sue one of my loan officers because he did a refinance and his score dropped from an 807 to a 790. And I was like, you will never take a hit on any rate ever in anything you do at a 790 credit score. I was like, but I had an 800. Who cares? So there are certain things. Don't worry about too much. Usually, people that pay off 30-year mortgage loans have other stuff and they're doing pretty good. But technically speaking, once you pay off, like even though like my student loan, I remember when I paid it off, my scores dipped a little bit, but then they eventually came back up. So it'd probably be nice to have a student loan.
Because you look online and you see all these different, like from here to here is great, from here to here is good. It's all different. Like what truly is considered, like how you were just saying, 740 and above, you're not going to see a difference in your rates typically. Like what do you see is like kind of your average or indicative rate in this day and age?
Yeah.
The way people are
I mean, we'll get more in depth in this later on towards the end of the presentation. But I mean, in the mortgage industry, typically 740. There's really not a rate hit above a 740, or is it a 750? You guys have stuff 740? Yeah, it's pretty typical. Now, each industry is different. They look at things differently. Sometimes, there can be cases where maybe you've got above a 740 credit score, but you get a bankruptcy. It wouldn't affect you in the mortgage industry if it's over 5 years old, but you go buy a car, and you're buying like some luxury car for 100 grand, maybe a Tesla, they may look at it differently. They may adjust your rate because of that. So every industry has their own things that they do, but in the mortgage industry, there are some pretty standardized guidelines for Yeah. We'll talk about that. There's a great section, and I know that NRL has some stuff they can do. Maybe not at a 500, but I know that NRL can do some stuff down pretty low, and I'll let them talk about that in a section here. So let's talk about the last two pieces here. They're both 10% of your score. The one is types of credit used, and the other one is new credit. We'll talk about the types of credit used first. So types of credit used. This is really, kind of looking at there we go. So types of credit used is so if you're having multiple types of, so like say you have 3 credit cards and 1 revolving account, that's going to be kind of the optimum what you need to see on your credit score. You're going to get a little boost in here by having 2 different types of loans. But also what calculates in this section that we really look at is if you have too much of a certain type of loan that the credit scoring system deems to be bad. Like, for example, a financial loan. Now, a financial loan, like a note loan through Sun Loan or One Main Financial, places like this, having one of those may not be a big deal, but having 20 of those might be a little bit of a problem, right? And that's happened. I had a client, she had 25 of them on her credit report, most of them from the Sun Loan. Now, when I asked her, it's like, why do you have all these little note loans on there? Now, on the mortgage credit report itself, there was actually a notation on there that said too many financial accounts, okay? But when I asked her, it's like, why do you have 25, of these loans on there? Because it really does look like you're not able to pay your bills. That's what it looks like. And that's why it's counted against you. Well, she said, I'm a teacher. I get paid once a month, and sometimes in the middle of the month, my kids want some toys. I was like, well, it's time to learn a new word. It's called no, right? But she had a hit on her credit report is because of this section here, is the types of credit used. Another example is like store cards. Another client I had up in Dallas. I love to pick on Dallas, being a Houstonian. Anybody here from Dallas? Okay, good. Oh, Ray is. He could probably relate to that. Okay, good. But yeah, she says she had 25 store cards on her credit report, and actually there was a notation on the mortgage credit report that said too many open store cards. Right? When I asked her, I was like, why do you have these store cards? Like, you must live near the Galleria, right? Their Galleria, not ours. Ours is better. But yeah, she's like, how'd you know? I'm like, I don't know, just a wild guess. But literally, and they were all on time. Nothing was late or anything like that. But she had 25 payments she had to make every month to different store cards. I was like, wow. I'm sure every one of them was like she went in there and they're like, hey, we'll give you 20% off today. Okay, great. And I'll open up this card. And I'll keep it and use it or whatever. But those kind of things can hurt you, and that can hurt you here in this section. But like I said, having a good mix of credit is what we're looking for here a lot of times. So if somebody has zero credit and we're kind of building from scratch, and they say, well, Chris, what should I do to get the best advantage? I'll say, go open up 3 credit cards and 1 installment loan. And an installment loan could be a credit builder loan, like we talked about, like a secured loan through a bank or a credit union. Those can help. But it's all, there's certain things and aspects that depend on it. But if you're starting from scratch and you ask me, that's what I'm going to tell you. Okay. Now the last part here is new credit. This is 10% of your credit score as well. There's 2 main parts about this. The first one is anytime you open up a new account, you're going to lose points initially for opening up that new account. Okay. Now you usually get those points back over a period of about 3 to 4 months. Now whenever you do open up a new account, there's actually a notation on the mortgage credit report, factor code 14, I believe, that says length of time since account has been established. And usually if you see that on the credit report, you know that there's a new account on there that is negatively impacting the credit score. Okay, it's built in there by design because in the first 90 days of any loan, regardless, is the highest rate of default happens in the first 90 days. So they build that in automatically so that when you open up a new account, your scores are going to go down. But sometimes for people building credit, it is a necessary evil that, hey, your scores may come down a little bit before they come back up. But the good news is you get those points back, and if it's a building credit situation, a lot of times you get those points back and then some. So, and then the second part of the new credit section is going to be inquiries. And this really is one of the most misunderstood things in the mortgage industry and the real estate industry is the inquiry and how it impacts your credit score. And sometimes people really freak out about it. So let me just throw this out to you as a question. I mean, what are your thoughts or what do you think about an inquiry and how it impacts your credit score?
I think if they're all close together, then it indicates that you're just looking for the best rate, but if it's like every 3 months, if it's all up within a month period.
So like a shopping window?
Yeah.
Okay. Anything else that you guys heard or about inquiries?
I've heard, I don't remember the number, but like you have basically a thing mortgage pool that you want within, I think 90 days or 60 days or something, and you're not one.
Okay, shopping window. Okay. Yeah. That's really, shopping windows are kind of a big thing about inquiries as far as like, do they exist or not? Now, I used to teach that shopping windows don't exist. But it's kind of like, oh, Bigfoot doesn't exist until you actually see it. And you're like, no, I swear I saw a Bigfoot. I got it on my phone, but then my phone died. I don't have it anymore. No, but I have seen for myself that shopping windows are a real thing, but there's a big asterisk to it. So how a shopping window, anybody heard that term before, shopping window? Okay. So a shopping window, technically speaking, is a length of time where multiple pulls from a specific industry within that time period only count as one, right? Now, the only industries where they do count those are going to be mortgage, auto loans, and student loans. Financial loans or credit cards do not have any kind of shopping window. So if you go to the mall and go around to 15 stores and apply for 15 credit cards, guess what? You get 15 inquiries that are all going to impact your credit score. Okay. Now, that said, there's a big asterisk to that, and this is where a lot of people that say, well, the shopping windows don't exist, this is really where, I point this out as, here's why you think this. It's because it's not that they don't exist, it's how they get reported to the credit bureaus. So I'm going to use a real live example and a story of a client that I had down in San Antonio. The loan officer actually came to me and said, hey, Chris, I got these 2 credit reports. Can you tell me why my client's scores dropped 35 points? The only thing different between this one and this one is the client went and bought a car. Okay, but the trade line itself, the car itself, is not reporting on the credit report yet. The only thing that is reporting on the 14 inquiries that came from the actual transaction. Now, he only bought one car from one car dealership, financed through one company. But there were 14 inquiries to get him there, and it's what's called shotgunning, or another term I learned recently was blast and cast. So that basically means they're going to go out and try to find you the best rate by inquiring with a bunch of different lending institutions. Now, they told him at the time, it's like, this is going to happen. You're going to see 14 inquiries on your credit report. Don't worry about it. There's a shopping window, so all of them will count as one. Not a big deal, okay? But, and it's something that doesn't always report on the mortgage credit report, but some of them do, where it tells you the type of inquiry, okay? Now, in this particular case, of those 14, 4 of them showed up as auto. The other 10 showed up as financial. Now, what did I say about auto? It was shopping window, right? What did I say about financial? It was shopping window. So, technically speaking, he had 11 inquiries that were hitting him. Now, each inquiry, on average, is about 3 to 5 points. So, what's the law of averages there? So, like 3.1 points per hit, right? 35 divided by 11, 3 point whatever. So that was probably about right. And that's why his score dropped 35 points. It wasn't the buying the car. Of course, when that hits, his score would probably go down again a little bit. But that was the reason why his score dropped 35 points. And that's why some people, when they see that, like, well, there's obviously not a shopping window, but they're not taking into account how it's getting reported. And is that inaccurate? Yes, it is. How does that get fixed? Well, we'll talk about that, how it can get fixed on our end, how to get fixed industry-wide. I have no idea, and it doesn't happen that often in the mortgage industry, but it did happen to me when I was buying a home. I had 2 people look at my mortgage. One of them showed up as home, and the other one showed up as financial. Now, it didn't really hurt me or anything, but now, so you have to be careful. That's why I only work with, Abe and Ray, and don't go anywhere else, and then you'll be fine, right? So you just have to be careful about it, right? Little plug there. All right, so I told you we talk about building credit. Let's talk about building credit. So let's go back to the pie, and let's go back to that 30% section. I remember I said that if you don't have a credit card, you're not scoring in that 30% section. So you're only scoring in 70% of the model. So it's like ordering a pizza from Domino's. It shows up at your door and there's 2 slices missing. You're gonna be like, whoa, what's going on? You're gonna send that pizza back. You're not gonna be very happy. And that's because you don't have the credit cards and you need to build credit. So a lot of things that we work on with our clients is building credit. And we recommend having at least 2 to 3 credit cards. And now, does anybody can tell me what a secured credit card is?
Where you put up the money?
Put up the money. Yeah. You have to pay that money back?
There's that, you know, you charge less than, right?
So the reason why I asked that question is it's not the same as a prepaid card, okay? A prepaid card is like you go to Walmart, you get their prepaid card, you put $300 on it, you use it, and then it's gone, and then you got to put $300 back on there. Now, does that prepaid card report to the credit bureaus? It does not. Okay. Even though you give them your information, it's got your name on it, it does not report to the credit bureaus. A secured card is you go to a bank, let's say it's Wells Fargo, you give them $300, you put it in a savings account, they hold on to that money, and then they give you a line of credit for $300. Now, if you go buy a tank of gas for $50, $60, well, you got to pay it back. Okay. That $300 does not make your payments for you, basically. They're going to hold on to that money until you close that card. Just like when you move into an apartment complex, you give them what? A security deposit, right? Security is the key word there. It's a secure deposit, and if you walk from that place, what do? They keep that money, right? And then some come after you for your rent and everything as well. But when you leave the apartment and everything's good, everything's clean, you shampooed the carpets and all that, you get that money back. It's the same thing with secured credit card. Once you close that secured credit card, you get that money back. But a secured credit card reports on the credit report just like any other credit card. Okay? So a lot of times when people have nothing, the secured credit card route is the route that they're going to have to go in order to help build their credit. So we actually have some places that we refer clients to. that don't even pull credit, and they only take a $200 security deposit. So a place called Open Sky is the place that we refer a lot of our clients to. They can go there with $200, give it to them, open up an account with them. They hold on to the $200 and get a credit card that's got a $200 line of credit. Usually reports to the credit bureaus in about 3 weeks. And the best thing about it is they do not pull credit. That means I have not had a single person get turned down yet. As long as you make enough income, you get a bank account and a job, that's really all they care about. I had one recently that did get turned down. That's because she forgot to put a 0 on the end of her income. And so she said she made $300 a month, not $3,000 a month. So, but when she fixed it, then it got approved. So, but that means there's no inquiry, but then also that means that they're going to get approved for that secured credit card. And it's going to help them start building their credit. And it's Open Sky, but then it ends up showing up on the credit report as capital credit. So, now, an unsecured card is a credit card where you don't have to put money down. They say, oh yeah, this person, we give them a credit card with a $2,000 limit, and they borrow against it. We know we're going to get our money back based on their credit score. Now, obviously, that's all credit score driven. But here's the thing about secured credit cards you need to know as well. They can also be credit score driven. So some people will say, like, well, Chris, I don't want to follow your advice and go to this Open Sky place that you're telling me to go to. I'm going to go to my bank, Wells Fargo, where I've been with for 20 years, and I'm going to open up my secured credit card there. They're not going to care about my 473 credit score. Oh, yeah, they will. They'll turn you down because they want to see a 580. In fact, some people I know, they could probably get an unsecured card if they listen to me easier than they can a secured card at their own bank. So, and I even had a place in New Orleans one time. I talked to the bank manager, and he was like, "Oh yeah, we have to have like a 620 credit score to get a secured credit card with us, and you give us $400 or $800, we'll give you a $400 line of credit." I'm like, "Well, that's like the worst deal I've ever heard." Iberia Bank or something. So that's kind of the difference between secured credit cards and unsecured credit cards. But with secured credit cards for people that have credit issues and are trying to build this part of their credit, it's kind of a necessary evil and kind of it's almost like an expense, even though it's not, because they're holding on to your money, but it's still money that's coming out of your pocket. So it is a necessary expense a lot of times. But if people have money that they've saved up for a down payment, it might just be something that's necessary. They have to take a little bit of that money, put it into this, and then put that money back into what they have saved up for a down payment. And then we kind of talked a little bit earlier about the difference between revolving and installment. But the key here is if you have nothing and you're building that credit is going to be the big part of it here. Okay. How are we doing on time? We want to take a quick break and maybe put in a food order. Julia, you want to take like a 10-minute break and maybe put in your food order now? Times what I see for people that, talking to the leasing agents that I've worked with, it is a mortgage credit score and a mortgage inquiry that's pulled. So
I think it also depends on who pulls it.
Yeah, exactly. Who pulls it?
If us one, and we pull it, but if somebody else pulls it, then it might be a financial.
What I've seen with some of the leasing places, places I work with, I've seen their credit reports, and it's like, it's the same credit report a mortgage company pulls. But I think like if it's a big, corporate apartment complex, then they're pulling credit, it may not be
I was thinking
a mortgage.
Like when we have a place that does the credit report, that kind of thing, all of that kind of stuff, all of
Yeah, and if you go through a service, it may not be a mortgage credit report. Ray is exactly right. It kind of all depends on who pulls it. Like I've got some leasing offices that they're both realtors and leasing agents, and they pull their own credit, and I'll look at it. And it's one from 12 factual data, and it's got the same algorithms that our mortgage company's using. So.
What about like personal? A lot of times you hear people want to get personal, either secured or personal unsecured loans to consolidate debt. Does that end up falling underneath
installment.
So that changes from, I guess, that revolving credit type to an installment type.
Correct. Yeah. So you'd basically be, if you have 5 revolving loans and you get a $30,000, personal loan to pay off those, and they tell you like, here's your monthly payment on those, and it's going to be over a period of 5 years. That's now an installment. Yeah.
So I guess in a situation that if you're all one type of loan, that would probably be beneficial to round out
There's so many different situations there that come with that. And since we have a break, I don't mind getting into the detail of it. But yeah. So, I mean, it's like, are they trying to buy? I always ask the questions like, well, what's your goal here? Are you trying to buy a home, and how quickly? Oh, well, yeah, I want to buy a home, but 3 years from now. Okay, but I want to get my finances in order first. They're two completely different things a lot of times. Sometimes finances are completely separate than your credit. I know that may or may not make sense, but it's true in that there's decisions you make financially, there's decisions you make for your life, and there's decisions you make for your credit. Okay, I'm trying to buy a home. I've got a contract on a home with a builder, and it's going to be they're pouring concrete next week. It'll be done in 4 months. I got to get my credit scores up, or I lose the home, right? And I lose my So then it's like, okay, we need to put all the financial decisions aside, and we need to do everything we can to help raise your credit score. Okay? And some of those things may not make sense financially, but they do make sense for credit. Other times, like, well, I want to get my finances in order. I'm not trying to buy a house for another 3 years. Okay, well, yeah, then maybe loan consolidation might be a good idea. Get all those things consolidated, and 3 years from now, it might not be as big a deal because right now you're drowning your revolving debt and you're close to bankruptcy. Right? So those are like 2 different things. And sometimes people, like I had a client call me up and say, hey, Chris, my daughter needs a car for college, and I figured I'd go get her a car and it would help my credit score. Is that true? And I'm like, well, looking at your credit, no, it wouldn't. It would hurt your credit score because it would lower your length of credit history, all of that, and but if your daughter needs a car for school, then go get her a car for school. It's like those are 2 different things. When people say, I wrecked my car and I need one for work, if I go get a car, will it have my credit score? I'm like, well, no, it won't. But you've got to get to work. So I mean, what? These are different. Yeah. If you lose your job, you're not getting the home. Let's just start there. Okay.
I love it when I hear I don't want to put my credit score when I need to.
Yeah. Exactly.
I'm afraid it's going to go down. Let's pull it now before it goes down. See where it's at.
Yeah. No. It's people and people. I'm sure you guys have seen this too over the years. Well, somebody will buy a car, a month before they move into the home, and all of a sudden, like, well, I hope you like living in your car. You're not going to buy a home now. But there are decisions that can be made where people make decisions like, oh yeah, I just got tired of the car I was in and I wanted to buy a new one. Well, great, now you're getting a home because you just increased your payment $300 a month, and now your ratio's out of whack and you're not going to get the loan. So there's like different things that. All these different moving pieces, and sometimes when people ask me questions, I was like, well, I might have to get the loan officer involved because this is a bigger question than just credit, because what you're asking me could affect other things in aspects of the loan, like, your debt to income, because I can look at it and be like, you got a lot of debts on here. I don't know what kind of loan they're trying to get into, what the ratios are, all that kind of stuff. All of those things kind of factor into sometimes the exact decision. That's probably a much longer answer.
Yeah, she's going to come over in a few minutes and take orders, so y'all feel free to look over and get what's smart.
Hey, Chris, I just closed the file. Talking about those one-day financials and everything.
Oh, yeah.
So they had a whole bunch of them.
Oh, yeah.
And I know what they were for. It wasn't, they had the income, but their house they were going to buy flooded an apartment. And it was the sun's out. So they were making repairs for the past 7 months. They have those small one-year loans. Knocking on the work today at flood insurance.
Yeah.
And they got through everything. The flood tore his car out, and he had a insurance payment that he got to where he was able to pay off the rest of the car, and the rest of that money paid all those installment loans off.
Oh, yeah.
So 8 months loan doesn't hard. Really get it done.
Yeah, that's another factor when you talk about being Houston. I remember after Katrina, all the credit issues that I saw then. Harvey brings up another. Ike was another one that brought in a lot of crazy credit situation. There's actually a Katrina story. There's a group of people from New Orleans that now live in Marble Falls. So what happened was there was a pastor in New Orleans that said, hey, God told me to get my parishioners out of here before Katrina comes in. So he got one of the church buses, went around to all his parishioners, said, get whatever you can, get in the bus, we're going west. And he did, he got them all, he stopped at Marble Falls, and he bought a piece of land there, and he started eventually later on, but subdividing. So now all these people that are Katrina evacuees now live in the Marble Falls area, and the pastor himself actually subdivided an area, created a subdivision, they opened up like 2 Cajun restaurants out there in the Marble Falls. But it turns out I ended up working on almost all of the churches, including the pastor himself, to their credit. And I remember the first loan I was looking at, I was like, you have to pay your student loans, your home is foreclosed. I'm like, you're a mess. It's like, but then he called me, he's like, oh, small Katrina. So those are all different things that kind of come into factor when we're talking about credit and natural disasters. And I've seen this a lot lately. Even for people that weren't affected by this, they'll say on the credit report, may have been a natural disaster and stuff like that. Yeah, things like that. Pay things off, get their home fixed up, and sometimes gap insurance doesn't cover everything, and you get repossessions on the credit report, all sorts of crazy stuff that happens to the natural disasters.
I thought that the medical bills were going to credit.
See, that's that myth that comes from the Vantage thing, where I think in the Vantage score, and I don't think they even implemented it, but they talked about it. So then a lot of people were saying like, oh, well, medical collections don't impact your credit score. That's what I read somewhere. Well, it's just lazy reporting. And even people that have had medical bills, they're paying their medical bills. I mean, it's the insurance company that it's their fault because they haven't paid it in time. So especially when you're talking like that, or a lawsuit, things like that, where they eventually get paid, but now you have all these, medical collections that show up on there, but they're paid medical collections, but they're still bringing down the credit score. I remember a client that I worked on, he had 800 credit scores, and they had one medical. It was a paid medical. It was originally a $24 medical collection that the insurance company didn't pay. But then they eventually did, and it showed up because it was like a coding error or something. So it showed up as a paid collection on his credit report. It never reported as unpaid. When it reported as a paid collection. And his scores dropped 130 points because of that one paid medical collection that was for $24. And it was $0. It was $0. And that one brought it down. Now I got it removed, and it was simple to get it removed, and it came right back up. So go ahead.
Okay, so my name's Sarah. I'll be taking care of y'all today.
Hi, Sarah.
So did medical bills fall under installment? Or is that revolving?
It's a collection. It's not a revolving. It's not revolving. It's still a collection. We'll talk about that here. That's the next kind of section that we talk about.
What is it when they say it's a soft pull? How does that affect?
That's good. I didn't actually talk about that in inquiries. So the difference between a hard pull and a soft pull is anytime you're applying for money or credit, you're going to have a hard pull against your credit, so that's going to negatively impact your credit scores. A soft pull is what's called a review pull. And that's, so whenever you do credit monitoring, that's a soft pull, it's a review pull. Or if a company that you're working with now decides to review your credit, like let's say Capital One or something, they can pull a review pull, and that is a soft hit to your credit. There's no negative impact to your score. But also credit card companies that want to extend you credit, they can do a soft pull. They're not going to see your full credit report, but again, they're just going to kind of see what category you fit into, and then offer you credit card offers based on that. But those do not impact your credit score negatively.
What about when we get a pre-approval letter on a
Those,
mortgage?
yeah, those
Are those considered a soft pull?
from like credit card companies.
No, from a mortgage company.
Well, a lot of
To buy a
times,
home.
okay, to buy a home, a lot of times, yes, that's a hard inquiry because a pre-approval letter is based off of seeing your credit score a lot of times.
So
So
that
whenever
is hard.
you send them to Ray pulls their credit, and he's like, okay, yeah, this client's a 680. We're going to get them qualified for an FHA. They're going to send you a pre-approval based on them having this credit score. Here's your pre-approval letter, and that does involve pulling the credit. Yeah, you have to. I don't think legally they can do a pre-approval letter without pulling credit first. So I did have a mortgage person out in Alabama. He was doing, even though if he pulled like a 470, he was still giving pre-approval letters. Saying like, but based on you getting a 620, you will have a pre-approval. And the reason why he did this was because that's all the builder needed was to go to a bank and get funding to build a new home. And they knew full well that they were not going to actually build that or sell that home to their client. But guess what? Now they had funding for a spec home. So there you go.
Hey, can you talk
Very
a little
shady.
bit about on some pre-approval letters how the different lenders will word things differently about if they like had a physical eye on a document versus not, so they can know what to look for?
Yeah, so on the pre-qualification letter, it'll say, of course, the purchase price, the amount that they're putting down to figure out the LTV, the total loan amount. Then it'll go over the main financials, your bank statements, tax returns, W-2s, and it'll say, did you talk to them verbally, like they told you this is what they made, or did you see it written? So you want to make sure you check, make sure they write either written or that's written, so you know that it's actually been verified, because a lot of that stuff will blow up in your face. Actually, it's not being calculated right.
Should we get a black in the Caesar with no free fun? Can I get a glass of water? Erica, George. Okay, so now we got the order put in. I figured that would kind of speed things up towards the end here. We can kind of get started again. So the next, the last page here, and so the next kind of part of this is we're going to, kind of talk about some of the negative stuff in regards to your credit. So we kind of talked about the positive. Now we're going to talk a little bit about the negative. So now the FCC did a study, and they found that 7 out of 10 credit reports have some sort of detrimental error. Now the most common error that we see on the credit report is going to be identity related. Now I'm sure if you turn on the news, you watch TV, you watch commercials, you're pretty familiar with like identity theft. Okay. Now there are identity theft and there's identity errors. A lot of times what is impacting the score is identity errors related, not identity theft related. The majority of things that I see that are identity related, I very seldomly see identity theft. I know that probably shocks you, but I don't see it that often. We are able to help people that have identity theft related issues on their credit report, but most of the time it's identity errors that we see that are on their credit report if it's identity related. Now, doesn't mean identity theft doesn't happen, but not all identity theft even raises to the level of showing up on their credit report. But we'll talk about identity theft here first, because it still is very important to understand what identity theft is. I think some people, it is a problem. I'm not saying it's not a problem, but I think sometimes people make more of it than it is from a credit perspective. Okay, but people sell on that. It can still be a fear because you don't want your stuff stolen. But as far as ruining your credit, it doesn't ruin as many people's credit as an identity error can.
I've had 2 different gas stations in the last 4 months, my credit card number.
And that's financial, see, and that's happened to my wife, where, you know, and I actually have that, I actually don't have it on here. I think I have it on the page. Skimmers, where
Yes.
They put a skimmer inside there, where it actually, you know, when you put it in, then they get their information. But that doesn't, that may impact your credit card statement or your debit card, but not necessarily end up showing up something on your credit. So it's financial related, it's not credit related, but still a problem, right?
Yeah, 'cause they charge it, but then you get the credit back, so then it doesn't affect.
Yeah, it doesn't affect you or anything like that. I mean, I guess where it could rise to the level of, for that particular instance, being a credit problem, if the, you know, the credit card company doesn't believe you and then the card ends up getting charged off. I've never heard of that before. Every time I've heard of this situation, the credit card companies, even your bank, in the case with my wife, the bank took care of it immediately. And then we posted it on our local Facebook page, and sure enough, like 8 or 10 other people immediately chimed in like, oh, that same thing happened to me at the same gas station, to where then we called the police department, they went out and investigated, and it hasn't happened since. And then turns out the people that were normally there in the store aren't working there anymore. Kind of coincidence, I'm sure. But
Yeah, they deny it if you call the store.
it's usually an inside job, because a lot of times it's not the simple skimmer on the outside. It's actually something that's being put inside there, which you have to have a key to get in there.
It doesn't matter if it's loose or not anymore.
So yeah, so if you check and it's not loose, it could actually be inside, but a lot of them will have tape that's inspected by the state. I think HEB has like a little lock that's lit up on there, so if for some reason that lock isn't lit up, I would probably go pay inside. Now, for me, having a 6-year-old and a 3-year-old going inside a gas station is not an option at all, because we'll come back out with like toys and candy or meltdowns, whatever. I'm like, I ain't going inside. So we're paying outside, and that's it, right? So, but yeah, so skimmers is a real problem. Some of the other forms is mail theft. And that is something that could definitely impact your credit score, because that's somebody that is trying to steal your identity and open up credit in your name a lot of times. Now, every once in a while they hit pay dirt and get like a credit card or something. That happened to us, my wife, we had our mail stolen and we didn't know it was being stolen. We lived out in a rural area at the time and had the old style mailboxes, and they were coming and swiping our mail, and they happened to get a Chase card, and Chase, I guess, allowed it to be used even though it wasn't activated, but it was up to $500. Now they covered it, and what they did was they went to Redbox, tried it, it worked, and then they went and spent like $350 at a Target, right? But Chase covered it all, not a big deal. But it definitely, they called my wife immediately. So they said, "Is this you?" And she's like, "No, we're not even in town right now. We're out of town. We're in North Carolina." So it's like we weren't there.
Even though the card wasn't activated, they were still able to use it.
Yeah, Chase had a policy like you could use it up to $500 without it being activated. So, which to me seems weird, but whatever.
Yeah.
Their rules. But then they covered it. It was not a big deal from us financially. They covered it. But a lot of times where mail theft comes in, where most identity theft is, they're trying to open up credit in your name. Dumpster diving is very similar. So that's where people are diving around in your trash to get information about you. And a lot of times they're not going to be the ones using it. They're just trying to sell it on the dark web, get a little bit of money, and it's all, I don't even know how much they make, but, and I've never been to the dark web. It sounds scary. It's like going into like the haunted woods or something. I'm not going to go in there either. But
They grab my information.
yeah. But apparently 90% of the internet is actually the dark web, not, we only use 10% of it. I guess it's the same with our brain, right? 10% of our brain. But that's all they're trying to do is to steal your information and then just sell it to make a quick buck. And then somebody else in Russia or whatever, they're the ones that do all the bad stuff. Pre-texting. This isn't something you do before, Ray's about to text somebody, so it's not something you did before. So it's not pre-texting. Pre-texting is where you actually, it's something where you get information from somebody and then use it against them to get more information out of you. So, you know a little bit about somebody and say, oh, okay, I know you're from North. You find out like, oh, somebody's from North Carolina, or maybe they went to, school out in North Carolina, and they call you up and be like, hey, this is the Wake Forest, Alumni Association. I need, verify some information from you. You're like, oh, okay, yeah, I'll give you all the information I need. I graduated from Wake Forest, and then I didn't. I graduated from Texas A&M, but just saying, if somebody did that, they would know a little bit about you, and then they use the rest of it to get other information out of you, okay? And there's other forms of this too, but I think, because I actually heard something in a news report that it is happening more and more, where people will they'll say that there's somebody that's in trouble and then try to get information out of you or money out of you. And that almost happened to me one time on Facebook, where somebody who I knew was in London was a friend of mine, a fellow Aggie, and but I hadn't talked to her in a while, and then and all of a sudden I get a message from her saying, hey, I had my purse was stolen, and I'm with my passport, my wallet, everything. Can you send me some money? Can you wire it? I'll give you the information. Can you wire it? And I'd seen on Facebook where she was in London, so I knew that. But then I was like, for like half a second, I thought, well, how can I get the money to her? And how much money could I get to her? And who else could I call to do the same thing? And then I was like, whoa, wait a second. It was only half a second I thought. I was like, wait a second. No. This doesn't sound right. I gave it like an hour. And then finally she posted something on Facebook. My account has been hacked. Do not give money to whoever. But it's kind of a form of pretexting where they're using something that's familiar to you to get either money out of you or get more information. Okay. Shoulder surfing is pretty simple. It's basically looking over your shoulder to get information. So like, they want to get your debit card PIN number, and then bump into you and steal your wallet, and now they got your wallet and your PIN. So whenever you go to grocery stores, make sure you cover that information up so they don't have very sensitive information like that. But also, like if you're on a plane and you're working and you got sensitive information up there, people are going to kind of look over at your shoulder or in Starbucks and get information about you, and that's what shoulder surfing is. Fishing, not something you do out here on this beautiful lake. It's a PH, not an F. It is actually trying to get information out of you by sending you an email that seems familiar. And I had this happen recently where I was at Twitter and I clicked on something that I wanted to see, and then it said like, oh, your security settings aren't set correctly within Twitter. Click here to log in and change your Twitter settings. And I was like, oh, wait a second, that doesn't seem right. So I exited out of there, just went to Twitter on my own, and those security settings didn't even exist that they told me about. So it was a link that was trying to fish and get my Twitter username and password so they could, hack my account. So those are all things but a lot of times where you have Google, your Gmail, your Yahoo, all of that can be fished pretty easily. So it's always best to turn on, two-step verification on everything like Facebook, Yahoo, your Gmail, all that stuff. Have a two-step verification. So if it's being signed in from something that's not obvious, then it's going to send you another way to verify. Oh.
And I got an email, I just doesn't sound right, but it's actually, I looked it up and it's gone around quite a bit.
video games are
Like a real thing. I mean, it was pretty.
video games are a real thing as far as stuff being stolen, and it can be a big problem because, yeah, like you said, there's so many different accounts now you have with Xbox. And one that I don't even do gaming anymore now that I'm married and have kids, but one of them was like Steam or something like that, a Steam account. And I get emails all the time saying that my Steam account has been used. I'm like, well, I'm not using it, and I don't really care what's on there. But someone's trying to hack into an old gaming account that I had. So the other thing too here that's not listed or listed on this page is, and it can be a big problem when it comes to credit, and that's basically just compromises, other entities that have been compromised. And you hear about this almost daily now, it seems like on the news, where you hear another company, namely like Equifax, where there was a breach, a breach of information where they now have, I think with Equifax, they had almost half of the people's information. There was one recently, was it Twitter? Yeah, it was Twitter, where I guess something happened and all of the employees of Twitter now had your Twitter password. So how many of those Twitter employees were honest? I don't know, but they're saying, I still haven't, but change your Twitter password because of that. Okay, saying that. Yeah. So things are like that happening all the time, where now your information is out there. I remember in the old days where to get people's address, you just go to the phone book and you looked it up, and now I guess it's a bad thing when people have your address. So, but all these things are dangerous out there and can be used to hack your identity. So now identity errors. Okay, this is when information that shows up on your credit report that otherwise doesn't belong to you. And this is really where we see the big problem. With identity errors. Now, same last name, same zip code. So if you're a Johnson, a Smith, a Lopez, a Gonzalez, a Jones, a lot of times you're going to see things end up on your credit report that don't otherwise belong to you. And that's because you have a common last name. And it happens all the time. So when I'm going through with somebody like, well, or is any of these items not yours? Well, yeah, this, and this. Like, well, congratulations, your last name is Smith. It wasn't that someone stole your identity. It's probably because your last name is Smith, and you're seeing those things end up on the credit report. Juniors and seniors is another big one. So if you're, Bob Smith Senior, it could be your son Bob Smith Jr. has a lot of bad credit, and it's showing up on your credit report as a result. And then another one that's missed a lot of times, but it is a bigger problem than most people think, is if 4 letters out of your name and 7 out of the 9 social security numbers match, then your files will actually merge. Okay, so the story I always tell about this is, and I've got a few, but this is probably the best one, is a client of mine, his name was Roberto, and his file merged with a guy by the name of Robert. Now, he initially thought, he's like, yeah, this guy Robert stole my identity and has been using it on my credit report. And Roberto even went to the length of filing a police report against this guy Robert, who he had seen, and he had done some research as to whose account this was, and he found out it was some guy named Robert. He filed a police report against him saying this guy stole my identity. Okay? And I was looking through there, and I already knew the answer before I even got through there, but because on the mortgage credit report, the loan officer who sent it over to me didn't catch it, but it said on there, social security number mismatch. Have you guys ever seen that before on a credit report? Yeah. So the credit report company itself actually catches these a lot of times. But in this case, for Roberto, there was an item on there as I was going through it. It was a Chase credit card, been opened up for 7 years, had a $3,500 credit limit, had about $300 balance on it, never missed a payment, never been late. And I was like, so is this the one? Is this one of the ones that this guy Robert opened up? He's like, yeah, he opened up this credit card, has been using it. And I'm like, okay, that's weird because he's the most honest thief in the world because he's opened up this credit card. It's a $3,500 credit limit, never missed a payment. And by the way, it's your best trade line. So we're not going to touch it, actually. We're going to leave it alone. he's like, well, what are you talking about? It's like, well, it's because if you look on the credit report, there's a social security number mismatch. So because their names were essentially the same, 8 out of the 9 numbers were the same on the social security number. Only one number was different. So his scores, as a result, his merged. Now there was some negative stuff on there that was Robert's, like some medical collections, but the majority of the stuff that was bad was really his, you know. So, but it can be a problem, and I have got some other stories of people where there were negative stuff on there because of the social security number mismatch, and it's because of this reason right here. But those are all identity error related things. Okay. Any questions about that? Now, the one thing I would, the other thing I want to mention is having a credit monitoring account can be very important to continually monitoring these things, because if things show up on there that are bad or someone's stealing your credit, you'll know about it right away. So like the site that we use, that every single one of our clients that enrolls in our program will sign up with Identity IQ, okay? And they actually give you $1 million of identity theft insurance. And if you actually go to our website, you can sign up for Identity IQ through there, and you actually get a little discount over what they normally charge. So I think their normal fee is like $30 a month for the clients that we have enrolled, and they enroll through that link. It's $20 a month. So, and we actually include that as part of the price, our monthly price of our service. Because one, it's very important for us to continually monitor someone's credit. That site actually allows us to pull a new credit report every 30 days, so we can kind of see what's going on, track the progress, track the scores, and all of that. But then also the ancillary benefit of giving them $1 million of identity theft insurance. And it has happened where a client was enrolled in our program and he saw an inquiry pop up and it wasn't his. And again, it wasn't identity theft, it was an identity error, but it was an inquiry that popped up that was new. It was identity error related, and we quickly got it fixed through their identity theft department because he was covered under their clause. And it's backed by AIG, a pretty big insurance company, so it's a good thing to have. Okay, so negative items. So different negative items that are on your credit report: collections, bankruptcies, charge-offs, profit and loss, tax liens, judgments, foreclosures, repossessions. You know, all these things are negative that can certainly impact your credit score and impact them from a just a regular, old collection, a judgment, tax liens. All those things have different repercussions. Now, if you have a tax lien, is it negative on your credit report? Yes. But it's also negative in other ways, because you can't get a loan if you have a tax lien, right? Because no lender wants to be the second lien holder to the government. So if you have a federal tax lien, you got to get those things taken care of. People ask me, like, well, Chris, I have a federal tax lien, can you get it removed? Well, technically speaking, by the law, I could, but it's still going to be an impact when you go to buy a home, because it's going to show up in the title search, because the title company doing their job is to say, oh yeah, well, this title isn't clean because they have a tax lien even though it's not on the credit report. So we always talk to people that have open tax liens. You got to get that paid off, or let's talk with a mortgage company and let's find out what are their guidelines as far as tax liens. Can you be in a payment plan? Does it need to be paid off? What is y'all's thoughts? I mean, when you have a federal tax lien, are you still able to get the loan done if they're in a repayment plan?
I think if they will allow that in a repayment plan, and if repayments are made, it might change that. They're not taxes, they pay that for taxes. Taxes is where the payment plan is place. You can proceed with the loan, but it's not like they will do that.
Yeah. So there's other options that we go through. It's not necessarily you have to pay off your $150,000, sales tax, whatever, because you own a business and you didn't pay your sales taxes. All those things, can be worked through, but it is something that has to be worked through. Okay? It's not like, oh, we're going to come along and make some magic thing happen where those things are going to come off the credit report.
Does it make a difference on the bankruptcy if it's say like it just started or if it says
Dismissed versus discharged. Yeah, so there's two types there.
it's just like in the process. But you still go into
Like in chapter 13. Yeah, I mean, as far as the credit is concerned, I mean, those kind of things can be taken off. But the bigger question is, you know, one is if you're under Chapter 13, I think the trustee has to give you permission to buy a loan, and you can still get the loan done. So then it's more of a guideline thing than anything else, because that's still a matter of public record. Even if we get it removed from the credit report, it still comes back to you have to go through the same mortgage guidelines. If you've had a bankruptcy in the last 5 years on the mortgage application, it asks that question, have you had a bankruptcy in the last 5 years? Even if we get it removed from the credit report, you still can't lie on a mortgage application.
I just mean on the algorithm. How much
no, this is a great question. I think if it does matter a little bit as far as the algorithm, but the date is really what matters the most. And I think if it's discharged and it gets older, then the less impact it has on their credit score. But if it's showing up as an active Chapter 13, then it's still up there even though it's older. It's really more to do with age. Kind of like a collection. The older it gets, the less it impacts your credit score. So usually I see people that have like a Chapter 7 and it gets discharged. Their scores are going to go up over time. And usually people that have been through Chapter 7 see their scores go up quite a bit afterwards because all that debt's been wiped away. So let's talk about collection. Now, we kind of talked about it a little bit, but let me ask this question in regards to collections. First off, does paying a collection remove it from your credit score? No. Does paying a collection help your credit score? Should. She's right. No. Can paying a collection hurt your credit score? It can. It's possible, yeah. So, because the collection goes off of the date of last activity, okay? So the newer the collection is, the more it's going to impact your credit score. The older the collection is, the less it impacts your credit score. The dollar amount has very little to do with the actual scoring itself. So, again, I always like to tell stories to kind of illustrate the point. I had a client in San Antonio. She called me up in tears. She just lost the home of her dreams. She was a single mom, 3 girls, finally getting her life back together after a messy divorce, had a contract on a home, 3 weeks away from closing. She gets called from a predatory collection agency, a medical collection, said, oh, well, you know that you can't buy a home if you have a medical collection, don't you? And she was like, no, I didn't know that. This is the collection agency talking. Like, no, I didn't know that. It's like, well, we're going to do you a favor here. You owe $800 in this collection. We'll only charge you $400. But if you pay today, we'll get it taken care of. She's like, okay, fine. Yeah, I need to get this taken care of so I can close on my home. She did. She paid it off. Scores dropped 50 points. She lost the home. Yeah. So her scores went from like a 640 to a 590. Dropped her below that level. And at the time, there wasn't a lot of wiggle room for lending. It was like a 620 or bust for FHA. So she dropped below that 620 level, and she couldn't get the loan done. Now, eventually, we helped her out. She did get another home. She got the loan, but she did lose that home that she wanted. And it was like the perfect home, perfect neighborhood for her and her girls. And, you know, but what can you do? I mean, you're going to sue a collection agency for paying them off? I mean, and then what are they going to say? I never told her that. She's making things up. And it's, you know, he said, she said. You can't prove something like that. But it happens. I mean, collection agencies, they're ruthless as far as what they'll say to get paid.
Yeah, they don't say anything to try and get something from you.
Yeah.
So what about a closed account is not expected? Closed account, but you get
So, closed, like a credit card, like you close down a credit card. If you don't mind just setting mine over there on the, by the window. Yeah.
So I fell behind on my credit card, but they told me after 90 days of paying on the so I owe you that credit card. So they told me to get a notice, but I'm working on that.
So whenever you have like a credit card where sometimes you can make an arrangement with them to close it down, and then, or sometimes they will close it down, but you can still make payments on it. It's still the ratio. Remember, we go back to that 30%. It's still impacting you there, but it's no longer positively impacting your score. It's just kind of it's almost like a negative hit against you until you get it paid off. Is what I see on those credit cards that are closed credit cards, but you're still making monthly payments. So you're not getting the benefit of having that credit card open any longer, but you are getting scored for the utilization percentage against you. So back to collections. When we talk to clients, I'm not saying don't pay a collection that you owe, but you have to be very strategic about what you do. Sometimes it can be best to, if paying the collection is what you need to do as part of the loan closing process, we'll pay it at closing so it doesn't impact your credit score. That's something where, you know, Abe and Ray, they do their magic, and they work that as part of the payoff at title, where you bring a check to pay that off, or, you know. But there are other times where it might make sense to do it if you're in, you know, a longer process of credit repair. Pay the collection might make sense, and that's all part of the credit coaching. So we're very careful as far as what gets done, and it could actually help us get something off of the credit report, honestly, because sometimes where if it's a paid collection, they just don't care. And so let's talk about the negative stuff and maybe interject real quick on how what we do to clean up that is that we go through an investigation and verification process where we ask specific questions about each item on the credit report that they are now required to send back to the credit bureaus the answers to those specific investigations. And if they can't verify that information within a 30 to 45 day time frame, then by law, it must be deemed erroneous and thus removed from their credit report. Okay. Now, in the case of like a paid collection, if we investigate it and it's been paid, that collection agency might just not respond, and then it comes off the credit report. So, but also with credit card collections, that's actually one where paying off a credit card collection where the credit card company itself still owns the debt. That's one of the few things where paying that can have a positive impact on your credit score, because a credit card, let's just say it's First Premier, and it's got a $300, you guys see these all the time, right? $300 credit limit, it's been charged off, they owe $450 on it. It's still scoring against you in that utilization section. So now it's scoring negatively as a collection, but it's also scoring as a 150% utilization score against you. And if you go over the utilization number we talked about earlier, that's a negative against you. So by settling it, and First Premier will take a settlement usually like 20 cents on the dollar, so you call them up and give them, you know, 90 to 100 bucks, and then they'll mark it as zero, even though you didn't pay the full amount. But now it's zero, your scores go up because that utilization score goes away, that 150% utilization score. So that's part of our credit coaching when we're talking about what might need to be done on a collection, and one of them might be, you know, settling a credit card collection where the collection itself is still owned by the original credit card company. So this is the part where I bring in the mortgage experts here and to kind of talk a little bit about the impact of buying a home, the impact of credit scores on each particular loan type. But real quick, there's FHA, VA, conventional. The one I did put on here is USDA. Do you guys do a lot of USDAs out here? Or you do? Yeah. So all of them have different credit scoring rules. But starting with FHA, I mean, what do you guys usually see on FHA as far as what scores do you need and what kind of scores can you get done with an FHA?
Well, it depends. For example, we have bars that are 800 credit score for what? A lot of it depends on how much money you're available for closing. If you go too low, the lowest I've done is 551 FHA. But ideally, you want to kind of be able to go 580 or higher. but we can go lower. Anything lower than that is going to be a little bit more of a down payment. For example, a 560 to a 580 requires 50%. You don't have the investment that we sell the close to. They want that upfront down payment. 580 just goes to that. As an example, that 551 you did, they put down 20% just to get the approval. It was easy for them. They sold their current home, but they had collected that popped up. And so with the payout from their home, they were going to put down 20% and go right back check. So, 2 or 3 years from now, once credit history goes back up, they're trying to get it to refinance if rates don't go crazy. VA, we can go pretty low in those as well. Ideally, though, for the battery itself, you want to say about a 620 and higher, and go a little bit lower. Conventional, a lot of it also depends on how much you're putting down. For example, you're going to view 620, they put down 20%, you're going to view that at a 625 foot short. They're going to put down less than that. But it was a little bit more difficult to get those all through. But I mean, if you have a 660 or higher with the original loan, putting 3% down, you really wouldn't have a problem. And I know I went over that pretty fast. So I can reach out to you guys in the future. I know you're meeting and you didn't want to write stuff down, so I can send more of a guide, so to speak, since you are the first. Basically, the first people that home buyers reach out to them, we kind of have that knowledge. We bought a jumbo loan, we had 7 sectors that might be over 680. 700 for sure, 680 to our days, 453. And we do have a couple, going back to FHA, we are able to do loans that we don't have a finance. They come up here. If that is the case, you can add non-fiscal credit, the cell phone bill, water bill, something like that. If they have their 12 months worth of that with good history, you can actually qualify with no credit. Whenever we do the loan to us, we do have to pretend that they have a finance because they don't have that credit established. So that's kind of how we price up rates and things like that for that particular borrower. But it is a possibility if they are ghosts. We've done a few of those pay cash. They have the bank account, they pull out cash, they pull out cash and pay. And that's the behavior. They were able to get the loan.
Something I always like to brag on with my guys is how seriously they take their pre-qualifications. I know as a realtor, pre-qualification is important to y'all because y'all don't want to waste your time if they're not going to qualify. It wastes everybody's time. But I'd say percentage-wise of the pre-quals that we issue, I'd say we end up closing probably 99% of them.
For the buyer.
For the buyer.
Process.
Out of
You know
your
what I
hand.
mean? So that's it's not really out of our hands. But yeah. Whenever Dave or myself have done a pre-qualification letter, we've done a due diligence. I'm not going to see one out where I think I can close. There's no point in me wasting time with something I won't.
I would say like 3 key questions would be how much money do you have saved up? Does it show job history for 2 years? And can you prove rental history for a year? And those 3 boxes check off well, then you're having a really good shot. Some of these lower score programs are harder outside the box. It's going to get down to having the down payment and the closing costs and having a little bit of money left over after you put your down payment down.
I'll keep diving into it. So, has anybody here like to y'all do a down payment assistance? was higher, but the rates keep climbing up. They haven't released any higher coupons, so they can't increase the rates to get more like credit back performance. For FHA, to go that program, you want to try to be around a 640. They do have another set program that just came over to us about 2 weeks ago. We go with the 640. You can get that particular program by 5%.
And with the step, they don't have to be first-time buyers, is that correct? And do you have any of the step Gold Star?
Yeah, that's the one you get on 640.
Okay.
Now it's on the weekly sale for us. I closed my first one 2 weeks ago. First time in this one. Because he didn't have the high enough credit score to go regular set, but he was able to actually go Gold Star. Yeah, we had heard of big hack. And those are all, so with set, you can also go VA, or USDA, you can also go utilize set as well. Usually with USDA, I'm no need to 100% finance it. Depending on the contract structure, they can have concessions. And then they can pretty much get more solid here going through the sets. And their set customers is pretty high.
I may have done one with the USDA, but what's the interest rate on the USDA and what do they have to do?
For annual levels and down payment system?
I'm sorry, yeah.
What, price went up the other day, like 6 1/4?
6 1/4?
Some album, there's actually a few in Dickinson. They could have a few of them. Yeah, I mean, I can see the link for USDA's website if they're interested in it. Yeah, there's one, you can even pull up the map, anything that's not shaded tan. Pretty good. Not really regular single family. Just regular single family home. As long as it's in that area, and the bar will qualify based on income. It's actually VA and USD are probably my two favorite ones. It's cheaper for that environment. It's a little bit more.
Great information. So this is my kind of my mortgage expert part of the presentation. They bring in a lot of information that I can't bring in when it comes to this specific part of it. So in loan types in relation to credit scoring. So it's very, very important. And I know NRL is one of the few that can do loans down, on lower credit scores. So did you guys learn something today? Good. Would you guys recommend other realtors to come and take the course? That's good. So if you, I think we had talked about doing, more of these classes. So if you want to spread the word to other people back at your office about the class, that would be great. And then just get in touch with Julia about scheduling some time when we do these again. But I also appreciate a good review, either on Google or Facebook. Here I've actually listed some links to our different places to review us. So our office here in Houston is off the Southwest Freeway, so you can leave us a Google review there. You can also leave us a review on Facebook and also Yelp to our Houston office here. So that would be greatly appreciated. You don't necessarily have to, give us a review for our services, but give us a review for the class and what you've learned here today. That would be very helpful. Feel free to mention NRL that so get a shout out to them. All of that kind of helps with getting information out there on Google and more people finding us and finding NRL as well. So I did Facebook Live with this. You can go to our Facebook page, facebook.com/elevatemyscores. Like the page and you can see all of the videos. I've done other videos. I do home buyer seminars as well. So all of those, some of them are posted on Facebook Live and you can watch those videos as well. So if you guys are interested in doing like a home buyer seminar, again, get with Julia and we can certainly plan on doing something like that with you guys. Any questions while you guys are finishing up your lunch? Anything else that you don't think we covered, or a question you had coming in that you didn't get answered, or anything that came up as we did it that you forgot to ask?
Probably difficult to answer. You probably have a lot of services, but in general, what price are we looking at for someone who wants to like have you help fix their credit? Is it like a monthly retainer type of thing, or like one?
Yeah. So if you look on the flyer that was put there, so we have 3 different plans that vary in price, service level, and time to completion. So the kind of really depending on for your clients, like what they, what's the most important thing to them? Is it time frame? Is it their budget? It would really depend on which plan they would choose. But basically, like if they want to get into our standard plan, it's normally $100 setup fee, but every client that gets referred through NRL or you gets $50 off of that, so they only pay a $50 setup fee and then a $70 monthly fee. But there is, like our most popular plan, which is our Plus plan, is normally $200. They get $50 off of that, so they pay $150 to start and then $120 a month. It's just a lot more aggressive. They get a little bit more service with that plan, and they're usually going to get done much faster than one of our higher tier plans. So if there's somebody like, oh yeah, I'm building a home and I got 4 months, I got to get this done, they're probably going to want to get into one of our more aggressive plans. If they say, well, yeah, I've got a year to get this done and I want to buy eventually, and money is an issue, well, those kind of people might sign up with our standard plan. So we want to have a different plan for every type of client, not just one cookie cutter plan, because some people are like, well, I got money, I want to pay for more. Can I get more? Well, no. I mean, if you have just one plan. Or other people, like if you have one plan that's really high, then they can't afford it, and that doesn't make sense either. So, but in comparison to a lot of other credit repair companies, I know, like especially up in Dallas, where some credit repair companies charge $1,500 to start, $300 monthly fees, and they do probably less than what we do. I think our prices are pretty fair. So, and our goal really is to help as many people as possible, because I've known Abe and Ray we're talking probably for like 8 years now, and I've helped a lot of their clients over the years. And that's the key. We want to help as many clients as possible, and that's the biggest thing that we're trying to do. So
what's great too that we enjoy working with Chris is the level of communication. If we have a mutual client that's trying to boost their scores to get them in the place to buy a home, he's communicating regularly with the loan originator to say, this is where we are, this is what's going on, because it really is a team effort. You gotta work together because you want to get to that end goal. And if he's working out on his own little island and we're working out on our own little island, it's not going to get anywhere. It's not a good way to do business. And so, having that good relationship between us, we feel confident sending our people, because there's a lot of options for credit repair out there, some of which you're not going to get your money's worth out of it. And we wouldn't invite him here to do something like this unless we felt confident behind Elevate My Scores and knew that they know what they're talking about. So, it's definitely, when we put on an event like this and sponsor it, we have personal confidence. We're not going to vouch for these people unless we feel confident in them. So we're really thankful to Elevate My Scores and Chris, because we do have that history together. So definitely trustworthy source.
Thank you. Yeah. And every client has a portal where they can track everything that's going on, and then also NRL, they have a portal where they can see what's going on as well. So it helps kind of all stay on the same page, and after every round is submitted, the client and the mortgage company is copied on that progress report that's sent out in between rounds. They can see, okay, here's how many things are being deleted, here's where the scores are going. And sometimes it's important because if the scores are going down, then you want to know why. You know, what's going on. It's kind of like you break a leg and it's not getting better. Well, why is that? There's something else going on there. And sometimes it's like, well, there's new collections showing up in the report, or you know, the credit cards that were paid down are now maxed out. We got to address that. You know, there's different reasons why things can happen. Some of them were bad, some of them were good. We always got to know and address those right away. So.
You may have used this already, but how long did you say the average time frame?
I would say the average time frame is about 6 months on average. That we can certainly get people done faster. I mean, I've gotten people done in 3 weeks before, but that's not common, right? You know, the common is, hey, they've got a 530 credit score, they need to build some credit, they got some stuff that needs to be cleaned up. We can go after that, and in about 6 months, they're ready to get it going on.
Another cool thing about having this in the toolbox is that sometimes we all want something to happen this month to get it closed or whatever, but if we have the intention of helping the family later on down the road, I mean it's always going to be nice to have in 6 months for our pipeline to keep things moving. And I was trying to does mine, but she had sent me a customer and we couldn't help them immediately, but we got them on the right track, started doing a few things that we could do ourselves. And next thing you know, we got a referral from them because we took the time to get them on track, And so now the people that we're helping are able to find their house now. So it kind of helps with your business too, to get more referrals for people who are seeing that you're taking that extra effort to kind of give them some type of solution or a plan in general.
Yeah, usually if you take time and help people, they're your best referral sources. I was telling this to a loan officer yesterday. I had a conversation with. He sent me somebody back in last January, and I signed up like 3 people on one night. And because of those 3 leads, there's been like 40 people that have enrolled in my program because I helped. They referred somebody and I helped them, and then they referred somebody and helped them. And it's like because people like people kind of have similar situations. And so if they have somebody like, somebody else in their family is going to sign up, and it kind of just keeps going on and on. So those word of mouth referrals from people that have credit issues extends out. So if you can help them out, you're going to get those extra referrals as well. So. Any other questions? And the last thing I would say is, if you have somebody that has issues, get them over to Ray and Abe first, because they could probably do a lot of things with them, without them ever needing our help. And then if they feel like they need, further credit assistance through, our program, then they'll refer them over to us. So the best bet is to get them over there first, and then have them refer them directly to us. So.
I can tell you that, Chris doesn't just select he'll look at the report and see if they really are a good candidate.
Yeah. I've turned a lot of people away from the program. It's like, I can't help you in your situation, or what you got on there isn't something I can help with, or you're drowning in debt, or what you want removed is unrealistic. I mean, there's lots of different reasons why I've turned people away. And sometimes they're surprised. I'm like, I can't help you. Like, what do you need? I'm like, well, I got money. I want to pay you. I'm like, but what you're trying to do, it's not what we can do for you. It's not going to help. So if we can't help them, we'll turn them away. But we'll always give them like, hey, but here's what you can do. Type of thing.
You got money to drop everything.
Well, sometimes it's just like, there's like bills, like they've never seen a bill they want to pay. It's like, they just got collections out there, and they're just not. It's like until you can stop drowning, then we can't really help you out. Like if you're not going to pay all these things off, yeah, we can get some things removed, but it's trying to bail yourself out of a boat with a leaky bucket. You're going to continue to sink. So you got to shore all those things up. You got to be able to pay them off. And I've had a few clients over the years where I'm like, okay, go do this. and then come back and see me. And then a year later, I'll hear from, hey, Chris, remember you told me to do this thing? I'm like, you actually did it? Like, yeah. I'm like, okay, great. Let's get you signed up, you know. It doesn't happen that often, but it happens sometimes. And then if you have any other questions, Erica, like I mentioned, is our local rep here. So please feel free to reach out to her. Her card and flyer is there as well with her contact information. So she would probably be, from our company, your first point of contact. But like I said, anybody that has issues, send them over to Abe and Ray. And then if you have any questions for our company, contact Erica first and email her. So, okay. Thanks for coming out. Enjoy the rest of your lunch, and I'll stick around for a little bit if you guys have anything else you want to talk about.
Thank you.
Yes.
That's awesome. Well, I'll go ahead and draw a couple of raffle prizes. I know some of y'all will probably be needing to hit the road pretty soon. But like I said, we're really grateful that y'all came out. We hope that it kept you entertained. I think for a CE class, this is about as entertaining as you can get. So, awesome job. opportunity to sit down and discuss their financial needs, etc. We're answering that phone website dedicated purely to your listing that you can share via social media, email, whatever the case is. They're very professionally well put together. We can help create flyers when you have open houses and things like that. We can always get, we have some flyer programs that we can co-brand, just general things where it's going to have all of your information, your headshot, your company logo professionally put on there, as well as ours. So if there's ever something I can do to help you boost your marketing, I have tools that we can use together to help that. And I'd really be honored if we could continue to grow the relationship. I know that coming out today, of course you're coming for the speech. I want to build some relationships off that, and I don't want you guys to walk out the door and forget about us. We really are here and we want to serve, so we'd be honored to have the opportunity. But thank you guys so much. I really appreciate it. Do y'all have any questions for Abe and Ray as the ranch managers? Or
One more quick question.
yes.
How does a rapid rescore work? When, they're right there. They're right there, and they get help from Chris or whatever. How do they get that up where you can go ahead and
So I did one before I came here. Had a customer, they are about 15 points away from qualifying to obtain down payment assistance. So right around the 605, I'm going to give them a 620 just to see if they have a shot. So they have 3 credit cards out there. They're all at their max. They're at, the maxes are small, 300, 400, and like maybe 700. And so she had her husband's pay came in. She paid him down to, I think, I told her to pay like 10, to a balance of $10 a piece. Order to rescore today. It should take about 3 to 5 days to get back. Because when I read the what if scenario that he was talking about, that's what they kind of mentioned. I said, you know, they have about $100, not $100, but about 5% of deployment. And they said if you pay these down, you have the opportunity to at least try to achieve. I think there was James Dean was going to go up maybe about 30 points, and it was going to go about 50 points. And that would put me above the 620. So I have a little bit of leeway there, showing me above the 620. But as soon as she told me she paid him down with $100 to rescore, she'll have it back hopefully end of this week or the next week, and if the scores are there, that's when I'll probably provide the pre-qualification letter so they go. I'm not even going to sit one out yet until they have the scores back. I don't want them looking in the hopes of it based on the rescore getting back. Because I have no idea what's going to happen to me now and when they get their results back.
Who pays for the rescore?
Who pays? I pay.
It's like $30 per year. So
Yeah, this one's cut.
That's good enough.
Yeah, I don't pass it on. We're not.
But a lot of times the customer doesn't realize how much the lender or the realtor does to work for them.
Right.
So it's nice to know that.
Today's, I did 3 credit cards for that buyer, 2 euros a piece. I think it cost $90. But it's an opportunity to have a shot. I'm pretty sure I'll get it.
And what was the name of the program you mentioned pertaining to the cell phone?
Which one?
The USDA?
The program with this where you use cell phone bills as
No, it's a regular FHA loan. So, I mean, when we pull the report, you know, obviously you don't want to see a
I think you call it the non-official.
non-traditional credit.
Yeah.
Yeah, cell phone, water bill. Your traditional credits, your installment loans, auto loans, credit cards, mortgages, student loans. But whenever we pull it, that's all we see. We don't see not credit cards. We don't see cell phone bills. We don't see car insurance. And we don't see water bills. So if they have a good history of those, you know, then we
It
can.
has to be 12 months.
3 of them, these 12 months.
But those don't impact your credit score.
No.
It's just for the guidelines of the FHA, which need to see 3 trade lines. So if you don't have sufficient trade lines on your credit report that are 12 months or longer, then they need to go to non-traditional trade lines, such as like
And
a
they just
utility
want to see
bill.
them have know about making payments.
But if you're a ghost, like if you've had your stuff in somebody else's name the whole time, then it can be a problem. So we talk to people about that with the credit coaching is, well, you're going to need to build some credit, and that credit is going to have to go towards the trade lines that are required from FHA. Another good reason why we say to have 2 or 3 credit cards in an installment loan is to meet that criteria within the FHA guidelines of the 3 trade lines, so you don't have to look at non-traditional. Because I talk to people all the time, like, well, all of my stuff is, maybe it's the husband and he's the breadwinner, but everything's in the wife's name, and so he doesn't have any traditional trade lines, or non-traditional trade lines that he can even use to qualify. So sometimes it has to be a traditional trade line on the credit report.
Another case, if they don't have a credit score, maybe their parents do, and if an individual doesn't have the non-traditional credit lines, maybe their parents pay for their cell phone, they live next to their parents. If the parents would co-sign, their trade lines would then help that main loan. So even though they don't have the non-traditional, the parents will on that first loan, if the parents co-sign.
Just because signing the drag credit down pretty good.
I mean, it's going to show up on your credit report if you co-sign.
You're responsible for that first
Yeah.
pay.
My daughter has 2 more bucks.
And on your credit card, I didn't bring this up, but there's 2 different. You can put on a credit card as an authorized user or as a joint user. A joint user is kind of like a co-signer, meaning you're responsible for that debt. Well, whenever you do an authorized user, like so say you put your daughter on as an authorized user on there, I mean, she's not responsible for that debt, right? It's just, if I put like whoever, like my wife or something, and I default on the credit card, well, she's not responsible for it. So
It's car loan.
car loan, yeah, that's different. You are on
2
the.
more bucks.
Yeah. But I see that a lot where people sign for, like grandparents will sign for grandkids, car loan, but they're making the payment, and all of a sudden they can't. Grandparents can't afford it, and now they have a foreclosure, a repossession on their credit report because of a granddaughter. And you see it too, where they just do it for a friend. And it's like,
My daughter missed a payment in January. Cindy,
I have a random credit question. It's not related to mortgages per se, but just with your expertise here. Lost my dad a couple years ago, and when he passed, I forwarded his mail to my address so I could start trying to close out his business, etc. And I started doing what I felt was the right thing, trying to make calls to these companies, and he was in a lot of debt, to say, hey, just wanted to inform you, so-and-so has passed, just to let you know, you can discontinue communications. And I thought I was doing the right thing. I thought it would be the easy thing, that I could just notify them. And it's like I was attacked by these credit companies when I was calling them saying, well, what's going on with his estate? Are you responsible for his affairs? Basically trying to turn that debt around on me when I know that I have no legal obligation to that debt. When someone passes, what's the best way to handle that? Do you just ignore them? Do you try and notify them that they're deceased?
yeah, I mean, there's a lot of other questions that come into that, like how is the estate done? Did they have a living will? And not being a lawyer, I don't want to say reject too much because I could say something that's wrong as far as paying the debts. But usually speaking, the estate is going to pay off any past debts, and then anything that's left over, I'm not 100% what happens to that. Again, I mean, everything is different as far as like who is responsible. If you're part of the estate, it could end up on there. I haven't seen it in the 10 years I've been doing this where I see like, oh, that was my deceased father's credit card and now it's on my credit. I've never seen that on a credit report that's negative. Have you guys ever seen that on a credit report where it's something negative, where it's like, oh, that wasn't my credit card, it was my dad's and he passed a couple of years ago and it's a collection? I've never seen that.
Yeah, that happened to me.
Yeah, and that's pretty much where I took it.
That'll be the next class. We'll do a probate class.
And he didn't have a living will, so it was, you can take that probate, get on with your bad self, do what you need to do.
Yeah, exactly.
And
That's probably what that would be my advice to answer your question is like, yeah, I mean, don't give the collection agencies or the creditors anything. And don't be like, okay, well, yeah, here's my information, here's my social security number, and here's my next to born's name. You know, it's like, you don't want to give them any information, you know, because you don't want them to try. Because sometimes collection agencies, right or wrong, could start reporting on you if you give them, because I have seen that, where it's not necessarily their debt, but something now is reporting on their credit report because
they've got that link.
They got that link. I'm like, well, this wasn't even mine. This was my daughter's, and now it's reporting on my credit report. Right, wrong, or indifferent, it's still on there. Now it's easily removed, but because it's not reporting accurately or correctly. But that happens all the time where things report because they have that information. They're going to go after whoever they think they can get the money out of.
I don't know that I could work for like a collection agency or a credit place. I think you would just go home and cry yourself to sleep at night after those whole conversations with people.
Oh, some of the stories, like one where talking to a mom, said, yeah, we have a collection agency. They called up. My 7-year-old son answers the phone, and their husband was deployed in Iraq, defending our country. And they said, and it was like a medical collection. They said, like, oh, if your mom doesn't pay this collection, then your dad's going to get thrown in army jail over in Iraq.
Oh, that's awful.
And so like the son's crying, telling mom, like, you know, you got to pay this off, or dad's going to jail, and all. You know, it's like, yeah. Another story of like a couple. They were, I mean, it was a family. They were from, I think, Korea, and they'd opened up like a chicken place here in the States. And they owed like $130,000, and the collection agency went and dove through. I mean, I was like, I heard this story firsthand from the collection agency, and they were laughing about it. I'm like appalled. And they're like, saying they went and talking about dumpster diving. They dug through the trash, found out the names of all the family members, found out that a lot of them weren't here legally, threatened to report them to ICE and have them deported if they didn't pay the $130,000. Of course, they did. And it'd be just like, it's appalling. Like some of the stuff that collection agencies will go through and do to get money. And they were laughing about it because this was back before I even got in this business. I was in telecom, and I was helping a collection agency set up their phone service stuff, and they were telling me the story and laughing about it. I'm like, that's not funny. I don't think it's funny at all. It is crazy. But the good news is there is a law, the Fair Debt Collection Practices Act, and I tell this to people all the time. If you do have predatory collection agencies, there is something that can be done with it, and a lot of times we will be that advocate by sending letters directly to the creditor using the Fair Debt Collection Practices Act, demanding that they collect in the right manner, and if they don't, they can face a $1,000 civil penalty per instance of collecting in an incorrect manner. And it could also include losing their license to collect in a certain state. So things like that, like what happened to that family, you technically could get reported to the state, and they could lose their license to, collect in that particular state. And I've actually talked to people that are ethical in that industry, and they live by those rules very ethically, and they get things done the right way. So, because I've had people call me, as a business owner, you're like, hey, what do you do with your, receivables that you can't collect on? I'm like, well, I don't worry about it, but I'm not going to send people to collections, so, but they were like, I went through his pitch, but I had an interesting conversation, and that's, so there are people that do it ethically, and then people that don't. Because, and that's what some people don't realize about collection agencies, at the end of the day, the person you're talking to is a salesperson. They make a commission off of what they collect. So they want to try to get as much money out of you as possible. So I always tell people, like, when you call them up, the last thing you ever want to do is tell them you're trying to buy a home. Don't say, hey, I'm trying to buy a home and I need to pay this off in order to close on the home. They'll be like, okay, we owe us $1,000, but now you owe us $1,200. Guess what? They'll make up fees to get more money out of you because they know that you're desperate to try to settle on that collection. You want to make it sound like, you want to put yourself in the power seat and not give them the power by saying, I need to close on this. in order to close on a home loan. That's like the worst thing you ever want to tell a collection.
Just from my experience, I used to work in the medical field. I was in the medical field about 10 years in our billing department, and kind of learned through the game that the highest discount they would offer, for accounts and collections was about 40% off. But the patient really had to haggle to get to that point. So, there's definitely room to like push a little further, push it a little further.
And on that same note, with credit card collections, once you go 90-day late, they put it into collections, and because of that, it gives them the ability to settle it by law. I think there was a law passed in like 2010 with the kind of revamped credit cards, and so that's why you see all these debt consolidation companies or debt negotiation companies where they're saying basically stop paying your credit cards and you negotiate your debt for a lesser amount. I'm not saying do that, but that's they're working off of the backs of that law. But if you do have a credit card that is in a collection and it's with that credit card company, you can usually settle it for a lot less, and sometimes even less than 40% off. Sometimes it's, like I said, First Premier will a lot of times it's like, they'll do 20 cents on the dollar to get it settled.
Doesn't that note on your credit report that it was settled and hurt you even worse?
No.
Wow.
It was a collection. It's negative. It's going to say settled for less than full balance. It's not going to be more negative than it already was. Because all it is a comment. But like I said before, a lot of times it helps you because if it's a credit card collection and it had a utilization that was higher than 100%, getting it paid down to zero is going to boost your credit score. Just the fact that in the comments section it says settled for less than full balance, that's not really negative. But technically speaking it is, because if it was a positive trade line before and you stop making your payments and let it go to collections and then settle on it, yeah, that's a negative because you stopped paying on something and it went to collections, something that was fully positive. But it's because you took the advice of like a debt settlement company that told you, okay, instead of making your payments to your credit card companies, make your payments, your minimum monthly payments to us. We'll put the money aside, and then all your stuff's going to go to collections. They don't even tell you that, but that's what happens. And then we'll start settling things on your credit report.
Oh, that's how they get all that food.
That's not what's
Oh my
because you hear that advertised all the time.
Yeah.
So that's what they do. They collect your money.
Yeah, so basically if you're making, like, oh, I'm paying $1,000 a month and it's just minimums on my credit cards, then they'll say, well, pay us $1,000, we'll put it into an escrow account, and then we'll start settling. But actually, they're not the ones doing it. That's what they don't tell you. So like Freedom Debt Relief and all those companies, they're just sales organizations, and you pay a monthly fee to be in the service, but then you also pay a contingency fee for the settlement itself. So you have lawyers that are a part of a separate network that's not really affiliated with Freedom Debt Relief at all. So they make their money, which is a contingency fee off of the settlement, but then you're making a monthly payment fee to Freedom Debt Relief just to have the account open. And that's how they make their money. And because I worked with a debt settlement company down in San Antonio. They would send me their clients after they got done because I could clean up a lot of that stuff after the fact. But they told me how the whole process works. It's like, you guys do the settlement here? It's like, oh, no, we don't do anything. In fact, a lot of times we don't even know if they're done or not because of the lawyers. They're the ones, and it's like a separate network of lawyers. They do all of that, and sometimes we don't even know when we're done. I'm like, all right, well. So we weren't able to really work together, but efficiently. But that's kind of how the process works. And the contingency fees, I've seen them as high as 50%. So that means if you have a debt for $1,000 and they're able to settle it for 20 cents on the dollar, and they take their 50 cents on the dollar contingency fees. So that $1,000 debt, they settled it for $700. It's really not that great. You save $300 on it, right? But then, oh, by the way, the government sees that $700 or that $800 really between what they settled it and what they paid. They don't take off the contingency fee. They see that as income because it's above $600. So now they're going to 1099 you, the collection agency, for the $800. So now you get a tax bill that you have to pay on that $800 as income. So by the end of the day, it's like by the time you pay the taxes, the contingency fee, and you're paying the fees to Freedom Debt Relief, or wherever the heck they are, you're not that much better off.
You might as well
Just
pay
take
your card.
You might as well just keep paying on it. But I tell people, if that happens and you have those things on there, like the guy that was telling you about, who came back to me a year later, I told him, like, hey, I gave him a plan. I said, pay all these cards off and do it this way. And he came back to me a year later. He's like, yeah, they're all paid off because they were all in collections. It's like, once they're in collections, you can settle them yourself and you can probably do better than, I mean, you may not get the same deal the lawyer would, but at the end of the day, you're going to get it better off. Even if you're settling at 60 or 70 cents on the dollar, you're going to be in a better position than if you did it through Freedom Debt Relief or something like that. Kind of crazy. I remember talking to a client, or she didn't end up being a client, but somebody recently, and I was telling her about that. She's like, okay, I just threw that thing in the trash. I'm not going to do it with them. Do anything with them.
Thank you.
All right,
It's
thank
very,
you.
very informative.
Thank you.